Debt investors will be among those glued to their screens today, waiting for the Fed's statement first and then Ben Bernanke's remarks to the press. Those investors include Joe Balestrino. He manages $15 billion in fixed income, including about $1 billion in Treasuries. Joe is portfolio manager and chief market strategist at Federated Investors. His $1 billion Federated Strategic Income Fund has a one-year return of 10%, beating 92% of its peers. He's live with us this morning from Pittsburgh. So, Joe, how important is today's Fed meeting, the statement, and Bernanke's remarks to the press?
It's more the latter, Eric. The statement is the statement. We would seriously doubt there will be anything materially different. QE2 to run its course, no change in the extraordinary period or the extended period language. Certainly none of that changes. The statement, as you just said in the intro, is historic. And I think there are some questions that will be asked that, frankly, have never been answered before. And I think more than anything else, what is the time period to extended period? Because that will be the first tangible piece of evidence that they've flipped the switch, in essence.
So, Joe, you've watched Ben Bernanke speak countless times, testifying in Congress, for example. He's made a few public remarks before interviews on 60 Minutes. Where could he go right as far as the investment community is concerned today? Where could he go wrong?
Well, I think where he can go right and where he has put drawn his line in the sand is this is now a defiant Ben Bernanke, as opposed to his early appearances early in his tenure. He was kind of almost an aw shucks, I'm a guy from rural Georgia, I'm going to work real hard. This is a guy that says, no, you need the help. The economy needs the Fed's help, and we're here to help it, despite the dissents of the Honigs and the Plossers and the Bullards and the Fishers. He's lining up who he needs to line up, and that's Janet Yellen and that's Bill Dudley. And I think we're going to hear Ben Bernanke tell us why the economy still is not on firm footing. So I guess that can be where he's right or wrong. He needs to instill confidence in the whole system.
So wrong being Ben Bernanke not being strong enough, not being forceful enough, Ben Bernanke appearing too cautious and perhaps mincing words to a degree.
I think that's exactly right, and there's nothing wrong in saying that the economy needs help. It's the manner in which one says it, and probably the conviction in which one says it, and then will act upon. So at this point in time, I think the odds, I would put minimal odds on both, but I think the odds of QE3 are every bit as strong as they are on the Fed actually tightening monetary policy over the next 3 months.
Oh, so a toss-up. Now here's an important question then. If it is a toss-up, if QE3 could be coming, or we could get a rate hike of some form in the next several months, how do you play the Treasury market?
Well, there's a lot of headwinds out there. The Treasury market is the safe haven by definition. Despite S&P's action, they gave us the proverbial shot across the bow. The reality is when people get scared, when anxiety reigns, people buy Treasuries. And oddly enough, the last 2 weeks, folks have purchased Treasuries and stocks at the same time. One of those opinions is wrong. And with all the headwinds out there, I think Treasuries are still a pretty good place to be.
Oh, Treasuries are a good place to be, but you don't hold a lot of Treasuries. And from what I understand, you've actually pared your bets down a bit. Is that to say that you're waiting for an opportunity to step back into the market, or you're not so certain that you want to hold Treasuries?
Yeah, I would say two things. Or basically, the answer to the question is one of time horizon. And there's a lot of notables out there sort of jarring in the journalist street, so to speak, as to should you own Treasuries or not. If we're looking 3 to 6 months and anxiety's out there and there's so many international challenges from oil to Japan to emerging tightenings, et cetera, I think Treasuries are a pretty good place to hide out. If we're talking 12 months, 24 months, the economy's on its way. It's not booming, but it is recovering. The world is recovering much faster. In that longer-term horizon, Treasuries have no real place in a portfolio. But in any anxiety, uncertain environment, forget about anxiety, just uncertainty breeds volatility. Volatility breeds higher Treasury prices. So it's a short-term versus long-term.
Is that to say, Joe, that you think some other notable fixed income fund managers, like those who manage the world's biggest bond fund, are wrong to be effectively short Treasuries right now?
I mean, if I'm rolling the dice and short term means the next couple of months, I would probably say I'd rather have the other side of that trade.
All right, Joe, great to have you here on the Inside Track. Joe Balestrino of Federated Investors. He has one of the best performing fixed income funds over the past year.